All right, now let's try an example of amortizing a bond premium. The nice thing is it is very similar to the bond discount, right? It's the same formula, straight line formula, but now instead of saying total discount, it'll be total premium. Still the same number of interest periods. Okay. And we will base it off of the example we did not too long ago for Blanca Company. And now we're going to take the one B, item B, where the bonds were issued at a premium. And again, we knew it was a premium because it was over 100. So that's the one we'll look at in this example. So again, assuming that we record depreciation twice a year, our journal entry would be on June 30th. We would have interest expense debit. We would have cash credit. And normally every 6 months, we record our interest payment to our bondholders. So to record interest payments to bondholders, but we also have to record the amortization of bond premium. And again, we're gonna use the straight line method. So you can write that in there if you want, using straight line method. The formula again for your straight line method is to take your total, in this case premium, total premium, divide by the total interest periods. Interest periods. Again, corporate bonds paid 2 times a year, so 2 times per year times the number of years. Let's go ahead and say that this bond is, we'll say B was for 7 years. We'll say life is 7 years. And we'll say it's 12% interest. And again, the problem would tell you all this, but I'm basing it off of a problem that didn't have that, so that's why I'm giving it to you here. Life 7 years, contract rate 12%. Times 7 years. So that's 14 interest periods. And you're going to take your total premium, in this case, $14,000. At least our math is easy. So this is our amount to be amortized. Amortized each interest period. Now the normal balance for a premium we see here is credit. If we're amortizing it, we're trying to decrease it. So you want to do the opposite, or debit. So you'll have a second debit account at your interest date, and that will be the premium on bonds payable. We know how much we're going to debit it for now. This is debit column, credit column. Cash, your cash is always PIT, so I don't want you to think that it's your interest that's PIT, it's the cash that's PIT. Okay, P stands for your par value. Going back to B, our par value is 700,000. I gave you a contract rate of 12, and you assume it's paid twice a year, every 6 months. So you could do 6 over 12 or 1/2. Right, either way would be fine. Okay, math that out, and you get 42,000. Right, so interest is pretty steep on these bonds here. $42,000. Now, amount to be amortized each interest period used to reduce interest expense. Okay, our discount increased our interest expense. If you remember the last one we did, it went from interest expense that normally be $30,000, but now it became $32,000 because we had to move that discount to interest expense. Interest premium, if you think about what's happening, we got more cash than we have to repay. We got more, so we have a benefit. We're going to use that benefit to reduce the cost of borrowing, to reduce interest expense. Okay, so this is now 41,000. and that's the appropriate treatment as referenced by GAAP. They don't want us to call it like interest revenue or anything like that. No, they say that this extra excess came as a result of borrowing, so we should use it to offset our cost of borrowing to reduce the expense. I guess the effect is the same, right? Whether we had income of 1,000 or reduced our expense by 1,000, but this is how they prefer to see it in the journal entry. All right, we did our calculation. Hopefully that was pretty easy. Straight line is so nice. If you continue on, you'll visit that effective interest rate method of amortization. But for this class, straight line is sufficient. And there's your journal entry.